One of the most closely watched names in AI, artificial intelligence, just took its first big step towards Wall Street. Last week, Anthropic, the company behind the AI chatbot Claude, filed confidentially for an IPO. And it won't be alone. OpenAI, SpaceX, both these companies are also circling public markets too, at valuations that would make even a seasoned investor possibly blink. Here's the catch though. When expectations run this high, the debut itself becomes a bit of a test. A weak listing or a stock that sags once the hype fades could be a pin that finds the bubble. So today we're asking the question on everyone's mind. Is this a once-in-a-generation boom, or are the warning signs there before a burst? We're going to dig into a little bit about the Anthropic listing, what it means for normal investors, look at where the real money is flowing, and ask whether there's a smarter, safer way to back the AI revolution without betting the house on one stock. To do that, I am joined, as ever, by my good co-host, Chris Tuite, who is Head of Consumer Finance at Communications Consultancy MRM. Chris, hello.
Hi Ed, how you doing?
I'm good, thank you. And I'm joined, of course, by our resident investing expert, Chris Ling, who is Chief Investment Officer at Stratiphy. Chris, hello.
Hi, Ed. Yeah, good to be here. Thank you.
This is episode 5 of Investing Stakes in partnership with Stratiphy. Stratiphy is an investing platform for everyday investors that uses algorithms to enact quantitative-based strategies for investing, something typically not available to normal investors, something that institutional investors typically only have access to. Now, Chris L., just tell us a little bit about Stratiphy for those who haven't caught Investing Stakes before, just what the platform's all about.
Yeah, so it's an investment platform which really empowers you, the consumer, to have a go at becoming your own private wealth manager. So it's using institutional techniques so that you can build your own strategies and portfolios of stocks and funds to create automated strategies that are going to work off different factors. At the moment, the 3 core ones are different momentum style strategies, which have historically achieved periods of outperformance. Hopefully this is something that we can empower you, the consumer, to have access to.
Yeah, so the whole point of the Investing Stakes series is Chris T and I have both invested our own money. We put our own money at stake on the Stratiphy platform to see how those investments perform through a few different kinds of strategies. We're going to look a little bit later on at how those are getting on for those of you who've joined us before and are following along. But the really interesting thing with Stratiphy is it uses this slightly different way of investing compared to just buying a fund or buying an index, so to speak. If anybody's interested in it, we'll put a link below in the description so you can check out the app. We've also got, for those of you watching on TV, maybe we've got a QR code that you can flash up with your camera to get access to the app and have a look at it. So please do give that a click. With that, let's get on with the show. As I mentioned at the outset, we're talking about the AI, and I know we're a bit scared of using the word bubble, but Anthropic is the really big news that's out there at the moment. They're going to be doing an IPO. It's been filed confidentially so far. Chris L., do you just want to give us a little bit of background on that? What's going on there? Why is Anthropic IPOing? Why is it of interest to us generally as investors?
The 2 things, yeah. So Anthropic are like any of the private companies they're getting to such a size now that access to capital gets harder to come by the bigger you get. So public markets are historically the place where you can get the biggest money, and that's to make the biggest investment. So Anthropic, like others in its space, so literally SpaceX, and later this year maybe OpenAI as well, all coming to the market. So I think even the public markets are probably going to struggle with the size, the unbound size of these IPOs that have never previously been seen before.
Yeah,
but the water and money raised is something not yet seen.
The Anthropic one, the suggestion that the IPO is going to be effectively nearly $1 trillion IPO, which is just extraordinary amounts of money. And as you mentioned there's a few others happening. And I think for me and Chris T, I'm going to ask your views around this a little bit now as well, because I know you've got them. These big IPOs, there's a lot of money flowing into this bit of the market, a lot of what is going up in places like the S&P 500 is to do with the AI trade and this kind of thing. Does that start to, for you, Chris L, first, before Christy, I'm going to come on to your concerns. Does that ring any kind of alarm bells? Do you have any sense of caution around it? What is your sense of it at this point in the kind of market terms?
I think these kind of sexy IPOs do bring a lot of hype to the market, and that kind of, the worry is that it brings a certain level of energy to the markets that becomes unsustainable. Yeah, there is, I think, some caution needs to be put into people's minds, especially as these are very forward-looking companies. They have the ability to literally change the world and beyond. And the transformations that could take place there's a lot based on belief, I think, of what the future will look like and how that's going to be shaped. Fundamentals are not necessarily the best measure of how to value these companies. And I think a good amount of caution needs to be approached when looking at these IPOs and the market in general.
I think that brings me nicely, Chris T. This is where you've been seeing, I think you feel like you're seeing signals of problems, right? Do you want to share those problems with the group now?
No,
I feel like it's time. I see you waiting there patiently.
I'll let you guys have your say, and I want to wade in with my less than 2 pennies worth. So long-term listeners to Investing Stakes will know that I am I hesitate to call myself an AI skeptic, because what you said there, Chris, is absolutely right, in that it has the power to change the world, and it fundamentally will change the way that we operate in many sectors, right? I think where my concern is where the market sits at the moment. And I'm a person who deals in kind of big narratives, and I don't get down into the detail. And that's why something like Stratiphy works for me, because it's like I have a broad idea of where all this is going, but I don't have time to drill down into minutiae and which firm can do what. So I let the quant technology do that for me. But my concern, to get to the point, Ed, is that I think that the CapEx spend, so the capital expenditure spend of some of these large AI firms, the ones Anthropic, as you mentioned, OpenAI, is massive. It's huge. And having listened to a few sort of experts in the space a few months ago before we started doing this, their questions were the revenues to match the expenditure those numbers don't seem to add up, or aren't going to add up in the short term, which makes me think, I think we could have, if what you're spending isn't being matched by what you're earning, and yet people are still giving these amazing valuations on what the future might look like, then there is going to have to be a reckoning with gravity at some point. And people are going to go, yeah, but that's fine, but maybe not in this way. Maybe not where we're building huge data centers that can have huge amounts of compute power, which is going to drive AI compute power all the way through, and that we're going to be able to, this land grab for infrastructure needs to be funded somehow. And so what I don't want to do is to pile into it now. There be a correction when people start to realize, actually, what we've done is we've invested heavily in infrastructure that we don't necessarily need, and we also have pricing models that don't necessarily work. And the other thing that kind of raised this with me was, I don't know if you saw the news recently, Ed, but there were some firms like Uber, Duolingo this week, and Microsoft who are on the record sort of saying they burnt through their AI budgets. The token use that they've been doing the expenditure they've been spending on it has been huge, and they haven't seen that pull through into actual tangible business benefits, which has led them to slow down on investing in this in the same kind of slightly haphazard or reckless manner, in terms of just use it and we'll worry about it later. I think Uber burnt through its 12-month budget in 4 months with people using this kind of metered approach to accessing AI services. And so the numbers, if they're pulling back already, and if, the amounts that you and I are paying for our ChatGPT subscriptions are not necessarily going to be able to fill the gap that's left by the CapEx expenditure, then I think there's going to be a reckoning. And then after the reckoning, we'll see what comes out of it the other side, and then AI will carry on into the future. So I'm not a complete skeptic on AI. I think it will absolutely change the way that we do things. But I think maybe the current way that it's all structured feels a bit too top heavy and idealistic, and I think it might fall down. And then the other thing in the sort of near term that I'm thinking about is it's all been driven by a few sort of tech bros, right, that are taking this forward. And actually there's going to be rubber hitting the road where governments can't let this carry on unfettered. It needs to fit into social cohesion. So the brakes might be put on there as well. And that might have an impact on valuations and stuff like that too. So my slightly AI cautious strategy on this, not slightly, very cautious, is that I don't necessarily want to invest directly in these firms, because I don't know which one of them is going to end up looking a bit silly when the tide goes out. But what I do want to do is invest in the infrastructure around them, which I think will continue to be relevant, not just in an AI context, but in a wider economic context. And that's why I focused on old school, harder assets like energy, like infrastructure, like financial services, all those things that we're going to need in the AI boom, but also around the AI boom to try and diversify my risk. Hopefully that's making sense, Ed.
Yeah, it does. I think I saw something really interesting recently about back to the IPOs point, where part of the attractiveness of IPOing is not just that you're then on a public market and you have access to the benefits of that. It's also that there is so much unsophisticated retail cash out there, or money assets out there in the form of index funds. And as soon as you join one of the big indices such as S&P 500, you're essentially forcing enormous numbers of investors to automatically buy your stock because it becomes part of that index. They have to buy it, kind of thing. And so there's almost a sense there that essentially a lot of investors could blindly be forced into these businesses without really having any understanding of what's going on. Chris L., I'm going to come back to you now on this. Obviously, Chris T has concerns there about bubble and this kind of thing, but this kind of chat has been bubbling around for a while. From your perspective, is it a case of we need to just figure it out and ride it out? Are there things, what is the approach that you can take that is cautious, but also still tries to not just sit it out completely? I don't know. It's complicated, isn't it?
I mean, if we're talking about IPOs and how indices deal with that, these are of a size at the moment that and could go into indices at a level that they've not had to deal with before. The closest other example, perhaps most recently, I think, is maybe Tesla, when the S&P 500 finally included them, but they were already at a sort of $1 trillion market cap or thereabouts. So it was going to become 2% of the S&P. And yes, you get a lot of index mutual funds following the S&P, and it is the most followed index, and therefore all of these index mutual funds have to buy it up. Does that present opportunities for vultures like hedge funds to come in and prey on those poor index mutual funds that are having to buy up those stocks? I think there is a little bit of that, but they are also run by very professional organizations that are aware of this and will not try to just buy it all on one day so they minimize tracking error. They'll stagger it over a period of time and probably buy ahead of the index inclusion and after, and do lots of different things to try and mitigate some risks for the investors. As an index investor, that is part and parcel of what you're buying with when you're buying the index. You're trying to buy what is the broad representation in the market. And when they become public, that is part of that representation. And perhaps if you're trying to be broad-based market investing, then you're trying to diminish that responsibility to yourself, trying to understand what you're investing in individually. And yeah, they will come in at reasonable weights, but probably not enough that is going to or float your portfolio. So something to concern yourself with, yes. But I would argue if you're in it for the index investing, then that's what got to go with the flow. That is literally part and parcel of the index investing. Yeah.
So what about, and that AI kind of, the concern around the bubble, is there anything we can do to even not necessarily do anything, but to mitigate our own concerns about it, perhaps? And I appreciate that you can't call a time on it, and people who've been calling bubbles for ages and then sit things out and stuff goes on for another 2 years and then everybody laughs at them for trying to call it out at that point. It's very difficult, isn't it?
I refer you to my beige fox strategy. That's what you do, isn't it? You just anyway.
Well, this is what we're going to get onto. We're going to look at the stocks, and we're going to look at these stocks and this idea around picks and shovels a little bit, which is it sits back a little bit from the direct AI play, and I think that's possibly one of the strengths of your portfolios, Chris T. Before we do that, Chris L., did you have any thoughts on that in particular, or what's your sense of it?
Yeah, bubble fear is going to be very real when, particularly in the semiconductor space, where we've seen it was already arguably in bubble territory, and then it's just doubled. A lot of semiconductors doubled in the last 4 to 6 weeks. Like you say, Ed, at the same time, trying to call the top of these bubbles is very difficult because, yeah, some will say they seem very expensive 6 months ago, but then earnings improved. They increased their earnings, doubled their earnings, or quadrupled their earnings, and so then suddenly they seem reasonable value again. And at what point is it actually defensible that this is just a new normal for these companies? That they're seeing a genuine re-rating.
I think that's perhaps what's compelling with some of the Stratiphy strategies, though, because things like moving averages and MACD and those sort of things attempt to alleviate some of these issues and momentum, because it looks at what the stock is doing over a period of time anyway, doesn't it? So it's extrapolating some of that performance out and working to mitigate. Is that fair?
Yeah, exactly. So the various strategies, they all work on the same sort of or similar momentum principles, but it is how investors are moving their money around. And obviously, nobody was talking about some of these semiconductor stocks 12 months ago. They were prior stocks had gone nowhere. They've been down significantly over on a sort of 3-year basis. And then suddenly some of them are up 600,000%. Micron is an interesting example in the US where it's just completely exploded, and it has continued to keep exploding. But it's the kind of momentum strategies that is picking these stocks up when they're getting genuine follow through from investors pouring money into them and following, whether it's a re-rating on earnings or whether it's a earnings multiple compression or whatever's happening is that a lot of money is going in that way. Momentum strategies seeing that, buying with that, and then when it starts to slow down or taper off, the momentum strategy is hopefully picking that up and going, okay, there's something else better. The energy is going into, say, people's investing energy, that is. That's not necessarily energy stocks, but we'll come on to that, I'm sure. But yeah, it's a good way of picking up some of these trends that is being dictated by how investors are shifting their capital around.
Yeah. With that, I think we should have a look at the strategies. Here are the strategies as they stand. For those of us who have followed us in past episodes, you will know now that it has been a bit close between Chris T and I. But as you can see here, the Ed Greaves Black Elephant is still in the lead.
The comeback kid has roared ahead again. Let's see, like I said, you're roaring off towards that cliff edge.
You were roaring ahead, Ed, like about 2 weeks ago, but that's been reined in a little bit.
It has been reined in a little bit.
The slow and steady infrastructure play is reeling you back in, Ed. There you go, over time.
For those of you watching, you can see our corresponding colours on the graph below. Now, we've also got Stratiphy's in-house strategy, which Chris L has informed me is purely UK, which is why it's quite a bit behind our portfolios.
Because we're a combination of US and UK, Ed.
We are, yeah, that's right. However, it is still outperforming quite nicely the FTSE 100, so I think that's a good reflection on the momentum strategy there. What's interesting though is the pure S&P 500 is ahead of everybody at the moment, and I think that probably speaks back to the AI discussion that we've been having, which is that's what's pushing it on, right, Chris L?
Yeah, exactly that. So you've got a little blue dotted line halfway through the charts there, but there's a real divergence between UK and US stocks, and it's really, and there are plenty of other countries we could draw in that as well, but the US is being very much led by the AI stocks, and particularly semiconductors and those kind of stocks that are driving some of that performance in that. Portfolios light on that or light on the US generally are probably going to struggle a bit more.
Now, this brings us, I think, to the stuff we were going to talk quickly about, the picks and shovels play. Now, some of you might have heard of this as a concept. We're going to look a little bit more closely through the kind of lens of Chris T's holdings, because one really interesting thing that's happened with the strategies is mine has continued to not buy or sell anything. It's sat, and let's have a look here. It has sat effectively on the same holdings since right at the beginning. Chris T's has moved rather a lot more, with executing trades effectively to meet the style of his strategy. That being said, he has some kind of, you've got top performers, Chris, and the top performer there is currently still Marathon Petroleum, which I think was a good one last month as well.
Yeah, a bit further, a couple of months back as well, with all the kicks off in the Middle East,
And that is what we call a picks and shovels play. Chris T, do you want to give us a very quick breakdown on what that is? Because I've mentioned it about 4 times now.
Yeah, so it refers to the gold rush, I think, and do jump in if I butcher this, gentlemen, but back in the day when there was people heading west of the United States trying to prospect gold out of the ground thinking they were going to become rich, actually the people who became rich weren't the people looking for the gold, but the people who sold them the picks and shovels. So it was the industry that sprung up around this gold rush that ended up making people wealthy. And so if you apply this same principle to what we're talking about here, AI is a very energy intense industry. Obviously, we talked about the data centers and the requirement for power to power up the whole global economy, but specifically the discussion about the energy needs of AI. And my plays are more around kind of infrastructure, with Marathon Petroleum in the fact that it's the old school fossil fuels that we need to make everything work. And then there's some other people in there that I would call kind of financial infrastructures. Morgan Stanley, Goldman Sachs, other people like that who are helping to fund this kind of stuff or that are helping the global economy to continue to work. So they're AI adjacent. AI relies on all of this stuff in the same way that the entire global economy does. But also they're slightly separate so that if there is this reckoning that I think may be coming in the short term, that they won't be too badly stung by that. And then we can have a look at when the dust settles about how we can change the portfolio.
Yeah. Chris L., do you think there's a kind of a viable argument there that actually, and because Chris T's portfolio, he specifically at the start of this series opted to not buy those technology kind of stocks, whereas I've got Alphabet, which is Google, in mine, and actually you've got quite a lot of it. Is there a viable argument there that picking some of these picks and shovels plays perhaps takes some of the edge off what you're buying, and then potentially what could be coming off on the other end of it?
Yeah, I think it's the most typical way to play an industry that is just beginning to dig the intelligence out of the ground now, and we haven't yet seen the full capabilities of what that intelligence is going to become. If AI is very much in its nascent stage, then yeah, at the moment we're just trying to produce and get going on getting a bit more of it out of the ground, so to speak. I think there are lots of different ways to play AI, and there will be lots of beneficiaries. It won't just be the Anthropics and so on who may or may not be monopolistic controllers of the intelligence space, but there will be many adjacent industries that are going to be yet to be spawned, I think, and also that are the current incumbents that are going to have their business models changed off the back of it and are going to be net beneficiaries. Yeah, having a portfolio spread into different names, I think, is a perfectly good approach to perhaps have a calmer way of investing in this space when the AI hype train is. Some people will get FOMO, a fear of missing out of these highs, but equally you could do very nicely in some of the other companies that don't attract the attention of some of the runaway trains.
That FOMO point's really important. Just on that, this is another reason for and I don't want to over-egg this, but my slight concern is that they've got these IPOs on the horizon, and so talking up the adoption of AI, the chat, you're not going to have a job in 3 years' time, or it's going to do everything for us. Let's see where we are. But actually, I think there may be some sort of marketing hype, in inverted commas, around that, which is supposedly attempted to drive the hype train around the AI stocks. Well, get on board because it's just going to happen. It's inevitable. They've got to worry about their kind of share prices in the round and what that IPO is going to look like. And so they're going to pump this message out there so that people feel that it's inevitable. And actually, as I said, if you look a little bit deeper, and I'm in no way a details man like yourself, Chris, and you'll have more of a better understanding of balance sheets and everything else like that. But I've seen enough speculation in the stories that I see in the media and everything else like that. Some of those numbers don't add up, going back to the point I made previously. So I think that's another thing that's making me slightly cautious, is the hype train needs to be hyped. And if you look at some of thinking about another big IPO that's happening at the moment, SpaceX. Elon Musk he's an arch storyteller. He's fantastic at doing that kind of stuff. So yeah.
I think, look, I mean, I'm acutely aware of it, and I'm especially aware of it with things like my pension, which is all just in a massive, is a huge weight into the US, because that is just how the global market is. So through that, I feel exposed. I'm not doing anything about it because I don't have access to my pension for another 20, 25 years anyway. So I shouldn't be really, I just doing it. This is what I quite like about the Stratiphy strategies, though, is that there seems to be a little bit more intelligence and nuance to the decision-making that goes into the strategies that I think is quite interesting. And it reflects, I think, Chris T, although your performance is a little bit lower than mine, you're still doing well.
Yeah, exactly.
You haven't got any of those kind of pure AI plays in there. So I think that reflects really nicely, frankly.
Yeah. I think also your Alphabet pick's quite interesting here, Ed, in that, and we should probably come on to that, but I think Alphabet's an interesting one because they haven't gone all in on it. They've got other irons in the fire, right?
Yeah, exactly. Yeah, and I think that's the thing that concerns me with things like Anthropic and OpenAI is are they this one-trick pony, or are they really this big thing that's going to just dominate and be the next Google or whatever? I think that more or less wraps us up for this episode. Obviously, we're going to keep an eye on all of these different themes Do let us know in the comments if there's anything you'd like us to look at, anything feedback you've got for our portfolios and our strategies where you think we're going wrong or doing well. Do let us know. We love to hear from you. We try and talk to everybody in the comments, keep the conversation going. With that, I shall say thank you, Chris L, for being the word of wisdom in the discussion as ever.
Thank you for having me again.
And Chris T, thank you for being my foil, and good luck for the next month.
Yeah, I've got a little bit of catching up to do. Yeah, fingers crossed.
I'm sure you can do it. With that, everybody, thank you so much. We shall speak to you again very soon. Goodbye.